What's up, traders? In today's video lesson, I will be giving you a quick and simplified guide on how to backtest smart money concepts. So stay tuned. Now, as I always like to do with these video lessons, we're going to start off with a little bit of theory, discussing what backtesting is, why it's beneficial, before we dive into the charts and actually implement some of that theory. All right. So before we get started, I just quickly wanted to remind you guys of our simplified smart money concept setup. I'm a firm believer in the more you see something, the easier it is for you to spot it in the live market conditions. And that's why I try to show you guys the simplified setup as frequently as I can when performing these video lessons. So essentially what we're trying to do when trading smart money concepts is we're trying to find high probability areas to trade alongside the underlying trend, right? In this case, we have a bullish market. We're looking for a bullish break of structure to the upside. We're waiting for price action to pull back into discounted pricing before mitigating a valid demand zone. And then after that mitigation has occurred, once an entry model has been satisfied, we then look to enter the market to continue with that underlying trend. Obviously, the same is true when we're trading in a bearish market, right? I know that it can be a bit daunting, maybe a bit overwhelming to take all of these concepts and to put them together to find a trading opportunity in the live markets. This is where backtesting comes in handy. What backtesting allows us to do is it allows us to put all of these concepts together, all right? Apply it to historical data in order to refine how all of these concepts work together, okay? So when we talk about backtesting, right, what exactly is backtesting? Essentially, backtesting is a great way of learning new trading concepts and testing those new trading concepts. It's a great way of developing and refining a trading plan, practicing how to execute that trading plan as well. Because once you have written out a trading plan, once you have come up with an approach to how you want to execute trades in the market, you write that down and then you need to go ahead and you need to practice how to execute that trading plan. By executing that trading plan on historical data, you are also gathering data on trading instruments and trading sessions, right? The more you backtest, you essentially start gaining confidence as a trader. So backtesting really is a valuable tool to use. It's a valuable skill to have in your arsenal, especially when it comes to trading smart money concepts, which can be very complicated concepts, all right? Now, backtesting can be done as frequently as deemed necessary. As is the case with any new skill, as is the case with any new lesson, topic, or concept that you learn, at the beginning, you will require a lot more time in learning that particular concept before you become competent in the execution of that concept. So at the start, you will backtest a lot more than 6, 7, 8 months into your journey, all right? 2, 3 years into your journey. Now, don't get me wrong. I have been trading ever since 2017. And till today, I still backtest. Obviously, I don't backtest as much as I did in the past, but I still put aside time to see whether or not there's any refinements I can do to my trading plan, any refinements I can do to my approach. Obviously, my trading style, my trading approach has changed over time. And the more exposure you get in the markets, the more you see little tendencies, the more you see little characteristics of the different pairs that you trade and the different sessions that you trade that you want to test out a little bit more, that you want to investigate a little bit more. So backtesting is something that if you truly want to be a successful trader, a consistently profitable trader, it is something that you do want to incorporate in your overall routine, okay? Now, every backtesting session needs to have an objective and it needs to have rules attached to it, all right? So some of the questions that you need to be asking yourself is, what are you testing? In our case, we're obviously testing smart money concepts. And the question that you also want to ask is, how are you going to test it? So as you know, there's a bunch of smart money concepts. Which specific concept do you want to backtest? Do you want to backtest the break of structure? Do you want to backtest the change of character? Do you want to backtest the frequency of supply and demand zone mitigations? Do you want to look at how often liquidity is grabbed before a zone is mitigated? Do you want to focus on imbalance? How often is imbalance filled before price action mitigates something? Or do you want to look at the premium and discount tool? There are so many different things that you can backtest. You can obviously backtest them all together, but there are so many different things that you can backtest. And before you dive into backtesting them, you want to have certain rules attached to how you're going to backtest. All right. Now, essentially, we have two ways of backtesting smart money concepts. The first one is your full trading simulation. With this specific approach to backtesting, you are trying to replicate a real trading session. And what I mean by that is you are trying to replicate a full day of trading from the minute you normally get your charts to the minute you would log off for the day. You're trying to replicate that trading session on historical data. All right. You're trying to identify setups that you would have taken in live market conditions. Now, another way in which you can backtest smart money concepts is called hindsight backtesting. Now, when it comes to hindsight backtesting, essentially what you're doing is you are studying setups after they have already occurred. You're trying to investigate how price action moved after the fact. Now, for reference, I am recording this video on the 18th of September, 2022. So what I want us to do is we are going to start off by looking at hindsight backtesting. Okay. Now, I do believe that there is a little bit of a misconception when it comes to backtesting. I think a lot of people are under the impression that the only way you can backtest is if you have either a paid version on TradingView or if you have some kind of fancy backtesting simulator. All right. I know, for example, on TradingView, the free version, the daily chart is the lowest chart that you can use your bar replay tool on. And then once you come to your intraday time frames, like your 4 hour, your 1 hour, then you need to graduate to the pro version. All right. Now, one of the nice things with backtesting in hindsight is you don't actually need to have a paid version of TradingView, or you don't even need to have some kind of fancy Forex backtesting simulator, right? When it comes to backtesting in hindsight, essentially all you're doing is you are investigating price and you are investigating setups after they have already occurred. With this type of backtesting approach, you are not trying to simulate real world trading conditions as you would be trading normally. You are just going in and looking at how price action responds to certain things. So let's just say, for argument's sake, it's Sunday, you're at your charts and you wanted to pull up the 4 hour chart on USD CAD just to see how the market responded to some smart money concepts. Well, that's exactly what we're going to try and do here. So as you can see, we're going to focus in on this bit of price action in here. Okay, so let's just focus in on this price action here. Remember, we're doing hindsight backtesting. Now, we can all agree that price action is bullish here, right? We're putting in higher highs and we're putting in higher lows. The first thing you want to do, you just want to mark out those swing points. So essentially what we can see is we can see price action is creating these higher highs. We obviously have a double top in there, and then price action is creating these higher lows. So you can see that essentially price action is pushing higher in this manner. Okay. Once you have marked out those swing points, you want to go ahead and you want to mark out your breaks of structure, all of your valid breaks of structure to the upside. Remember, we're pushing higher. Okay, so you want to focus on your bullish breaks of structure. We're just staying on the 4 hour chart now. So the first break of structure that we can see is obviously this one in here. Okay, that's our first break of structure to the upside. How do we know it's a valid break of structure? Well, because that break of structure led to the formation of a new external structure swing point. Okay, then we have a pullback, then price action rallies again. It rallies to another swing point, and we can mark this one out as our second break of structure to the upside. How do we know that that is a valid break of structure to the upside? Well, we can see that price action breaks an external structure swing point. It forms a new swing point, so we know that this is a valid break of structure. Again, we have another pullback. Price action rallies once again. What can we do? Well, we can go ahead and we can mark out that break of structure in here. And then finally, we have this break of structure in here. We can see that price action, after putting in this high, we have a pullback before a continuation of the underlying trend. So purely by looking at price action here on the 4-hour chart, we've been able to identify 4 valid breaks of structure to the upside. All right. So the next thing that you then want to look at is you want to see where these particular pullbacks came into before the underlying trend continued. All right, so let's go back and let's look at, after our first break of structure, let's look at where price action pulled into. So let's zoom in a little bit more here. And what we can see is, we can see that this bit of price action, this pullback after price puts in this high, we can see that this price action comes in to mitigate this 4-hour. Okay, it comes in to mitigate this 4-hour demand zone. Now, how do we know that this is a valid 4-hour demand zone? Well, as you guys have seen in the previous video on how to identify supply and demand zones, we have an engulfing candle. Okay, we have a valid break of structure to the upside, and we have imbalance that's left behind. So we know that this is a valid demand zone that has formed in here. So we can see that after the break of structure, price action puts in a new external structure swing point. After that external structure swing point is created, what can we expect? We can expect a pullback. Okay, we want to see that pullback come into a high probability zone. Now that high probability zone is now this 4-hour demand zone. All right, after we see the mitigation of that 4-hour demand zone, what do we then want to see? We want to see price action push up. We can target this weak high in there. So purely from this specific price action in here, right, if we wanted to test the smart money concepts approach in hindsight, what we can see is after price action puts in the high, we have a pullback, we have a mitigation, and then we have, after that mitigation, we have a rally. So price action pushes up, we can obviously we can aim for our weak high. And in here, boom, Bob's your uncle. If you're looking at trading the open of that demand zone, you have yourself a 5.2R trade. And then there you go. In that way, in hindsight, you've been able to backtest a long setup here on USD CAD, which satisfies our smart money concepts approach to trading. Okay. One thing that you can that is missing now from this particular setup is liquidity, imbalance, and premium and discount. Well, no problem. Do we have any liquidity above this demand zone before the mitigation? Well, as you guys know, liquidity comes in the form of equal highs, equal lows, double tops, double bottoms, trend lines as well, anywhere where you might have a collection of orders. Now, very, very quickly, you can quite clearly see that we have relative equal lows in here acting as liquidity. Okay, so you have relative liquidity sitting just above our demand zone in there. And then we've also got just a little bit of imbalance in there. We obviously know that the imbalance is necessary to validify our demand zone. But for this particular setup, all right, we have a valid smart money concept setup that plays out perfectly to give us a 5.2R trade. One other thing that we want to add on to this is want to ask ourselves whether this particular demand zone sits within discounted pricing of this 4-hour leg. Okay, because remember, with premium and discounted pricing, it allows us to identify those higher probability zones. So if we bring on our fib tool and we mark out our premium and discounting, remember you're going from your swing low to your swing high. This is my breakup structure in there. Okay, we can see that we have our equilibrium in there. This is our discounted pricing. This is our premium. So when it comes to trading smart money concepts, essentially we want to wait for price action to pull back to at least our discounted pricing before looking for those higher probability zones to continue higher. Okay, now in this particular case, you can see that the 4-hour demand zone, okay, it sits at the equilibrium of our premium and discount of this leg. Now, as I've said in the past, you won't always see price action pulling back deep into your discounted pricing before price action continues higher. A lot of times, price action will just grab enough discounted pricing at equilibrium before continuing with the underlying trend, all right? Another factor that plays a role in how far your price pulls back to is the characteristic of the pair, but also the amount of volume that is in the pair at any given time. So in this case, you can see that price action pulls back to just your equilibrium. It mitigates that demand zone before continuing with the underlying trend. But notice how, okay, notice how it left behind this 4-hour zone here. That's the first one that it left behind. Notice how it also left behind another 4-hour zone just down here. Okay, so one thing I think it's very important that you guys understand is just because you identify a demand zone in discounted pricing does not mean that you need to 100% see price action come down, mitigate that before continuing. However, marking out this 4-hour zone is not incorrect. Even though price action did not mitigate it, this is still an unmitigated demand zone. This is still imbalance that has been left behind. So at some point, price action, we can anticipate to come back, mitigate that, even if it's just a small reaction before continuing with a new trend. At some point, we can anticipate this 4-hour to be mitigated. It's just in the context of this particular 4-hour bullish leg, we can see that price action only mitigated this zone before continuing higher. So in terms of hindsight backtesting, right, we already knew that price action pushed higher from here. We went and we investigated why price action pushed higher from here. We then saw, upon further investigation, that we had a valid 4-hour demand zone in there. We knew that that 4-hour demand zone was valid because it led to a break of structure to the upside. Not only that, in terms of the overall setup, we knew that we saw that there was liquidity, we saw that there was imbalance, and also we saw that this particular setup led to a valid bullish push to the upside. All right, so in that way, you are able to, without paying for TradingView Pro, without paying for some fancy backtesting simulator, you are able to test smart money concepts on a static chart like this on a single time frame. Okay, but now what if you do have access to TradingView's Pro plan? What if you do have access to a backtesting software that you can try and replicate full on trading sessions on? Well, that's where the full trading simulation way of backtesting comes into play. So what I'm going to do is I am going to delete everything that we have on the chart in here. And what we're going to do is we're going to try and now replicate the same setup that we took in here. All right, we're going to try and replicate the same setup that we took in here. But what we're going to do instead is we're going to be bringing on our bar replay tool. And what I'll do is I am going to, let's just say we pull price action back towards here. So we've now brought on our bar replay tool, and I'm going to go to my daily chart. So the reason you want to start on your daily chart is, remember, you're trying to simulate live market conditions. You're trying to simulate how you would go about trading a real session. And me personally, whenever I get to my charts, I start off by just checking what my daily chart is saying. Okay, establish that underlying trend before dropping down to those lower time frames to find opportunities that are in line with that underlying trend. All right, so here on the daily chart, again, we can all agree price action is pushing higher. So after this point, we only have our break of structure in here. Okay, so we'll mark that out as a swing point. We have a pullback, and then price action breaks structure to the upside again. So from a daily point of view, you can see that essentially what price action is doing, okay, is we are creating these higher highs, we are creating these higher lows. So our anticipation now is, because we have pulled back from this higher high, the anticipation is that this high will be taken at some point. Okay, so we are currently bullish on the pair. We've just put in a new higher low. So if we come in on the 4-hour chart now, we can see that daily swing high up here, and we can see that daily swing low down here. Remember, what is the anticipation here? The anticipation is for price action to come in and take this weak daily high. All right, remember, this is a weak daily high. If I drop back out to the daily time frame, this is a weak daily high because it has failed to violate this low. So this is now a weak daily high. The anticipation is for price action to trade up to violate that weak high. Okay, so that is my weak high, and then we can tentatively mark this low as our strong daily low. Okay, so now that we have that daily picture in place, we go ahead and we mark out our more recent 4-hour swing structure. Okay, so in terms of our 4-hour, you can see the price action is essentially moving in this manner in here, right? So we essentially have this break of structure and we have this break of structure. Now remember, we are trying to simulate live market conditions here. So what we're trying to do is we're trying to find trading setups that we would normally take. So after price action puts in this daily low in here, we can see that price action pushes up, and then we have this break of structure in here. All right, this break of structure originates from this 4-hour demand zone in here. Okay, but notice how a little bit further down we've also got this 4-hour demand zone in here. So right now we're back testing. Okay, what we're trying to do is we are trying to identify a specific zone that we would like to see price action coming into to mitigate before continuing that underlying trend. Another break of structure that we also want to mark out, this break of structure in here, purely because this particular break of structure in here, this break of structure shows us that from a 4-hour point of view, okay, we changed trend from this bearish price action in here to then pushing bullish. Okay, so from my 4-hour, I am only bullish after this break of structure. Now that is significant because once price action breaks above this 4-hour high, right, we are then in line with that overall daily anticipation that we have of a bullish push to take this weak high, right? So this particular 4-hour break of structure is very significant. It shows us that change of character from bearish to bullish on the 4-hour chart. Okay, and then obviously we have price action putting in this particular high. So this is where we now try to start simulating a real trading session. So 23rd of August, this is 7 a.m. in the morning. This is more or less when I would be at my charts. Now, before I mark out this particular high, okay, I will go down to my 1-hour chart. I'll probably go down to my 15-minute chart, and I will try and identify whether or not we have a valid change of character in here on my lower time frame in order to validate this as a 4-hour swing point, as a 4-hour external structure. Now, if I zoom in here and just on the 1-hour chart rather, you can see that we have a valid 15-minute change of character that takes place in here. And if I just mark that out for you guys, you can see that we have this valid change of character that takes place in here. So that 1-hour change of character validates this as a 4-hour swing point. Okay, once I identify that 1-hour change of character, I can then go on my 4 hour, and I can mark this particular swing point out as my 4 hour week high. Okay. And then I'm going to mark this out as my 4 hour strong low. All right. So what we've essentially now done is we marked out our 4 hour swing points. Okay. We dropped down to the 1 hour chart in order to find a change of character on that 1 hour to validate this 4 hour swing point. Okay. Once I have that 4 hour swing point validated, I can then mark out my week high and my strong low. And once I've done that, I can bring on my Fibonacci tool, okay, my premium and discounted tool, to find whether or not these two zones sit within discounted pricing, which would then make them higher probability for potential mitigations before price action continues higher. All right. So now, from a smart money concepts point of view, this is the 23rd of August, 7 a.m. So I'm at my charts now. I'm trying to simulate a real trading day. What I then want to do is I want to play price action forward, and I want to see whether price action will come down to mitigate either this 4 hour zone or this 4 hour zone before continuing higher. Okay, so you can see that we have a lot of bearish momentum that comes into the market. Before we allow price action to play forward a little bit, I want us to mark out our imbalanced zones. We can see that we have two valid imbalanced zones in here. Okay, with this candle in here, what price action has done is it has inadvertently created equal lows. Okay, it has inadvertently created equal lows. So that's my liquidity. So what I want to do is I want to place a buy limit order at the open, and I'm going to be aiming for my week high. Okay, something like this. Obviously, you can drop down to your 1 hour chart and you can tell yourself that you're going to wait for price action to pull into this zone. And once price action pulls into that zone, you're going to wait for an entry model before taking your trade. Now, let's just say you want to trade this 4 hour zone specifically. Okay, so if we allow price action to play forward a little bit, we can see that we have a small bullish reaction after price action forms these relative equal lows. Okay, what price action then does is it essentially gets people into thinking that price is going to continue higher, but then what does it do? It actually comes back down, okay, to take out all of this liquidity that was built up in here. Yes, because remember, a lot of 15-minute SMC traders would have potentially seen something in here on your lower time frame. But what happens? They identified a demand zone that sits just above liquidity. So that is a low probability zone to trade from. Price action then trades into our zone. So at this point now, remember, I am trading a limit order. So at this point, and this would be the 25th of August, 7 o'clock, I am now tapped into my trade. So let's see if the trade is going to hold. So we get tapped into the trade. What does price action do? It trades in and then immediately trades out. And let's just play it forward a lot faster. What we can see, price action hovers before eventually pushing up to take our week high as anticipated. So in this way, you would now take your screenshots. Okay, you would take your screenshots. You would put this particular setup in Notion or whatever platform you're using for journaling your back testing, right? And then you chalk this down as a win. All along the way, you would mark out that this particular setup was in line with the daily trend. You know, my daily trend and my 4 hour trend was in alignment. So good trade. Okay. Now, I know that this was a slightly longer video, but I do hope that you guys were able to find some value in this video. Understand that with any new skill, you do require practice and you do require patience. Not everything is going to happen overnight. The great thing about trading is once you know how to trade, it is a skill that no one could ever take away from you. Okay, so I hope you guys enjoyed this video. If you did, please make sure that you hit that like button, subscribe to the channel so you don't miss out on any future content. I appreciate you guys so much for watching, and I'll see you in the next one.